Hello, everyone. My name is Julie Hollinshead, and I currently teach portfolio management and personal finance planning at the Illich School of Business. I've spent more than 25 years in my career as an investment manager, and I've also worked in the banking industry. Through the years, I've really enjoyed helping individuals and organizations build their wealth for the future. Today, we're going to talk about securing your financial future, some specific steps that are important for anyone, regardless of their stage in life. The presentation is for information purposes only. It is not in any way intended to be specific investment advice or financial advice for you as an individual. The media is filled with stories and statistics about financial security. But when you step back and think about it, what does financial security mean for each of us? Can you come up with a word that would describe how you would feel if you knew you were on a path to financial security? This slide has statistics from a careerbuilder.com survey done in 2017. I found it positively fascinating that 78% of Americans live paycheck to paycheck, and 1 in 10 people making more than $100,000 a year live paycheck to paycheck. So clearly, financial security is not solely a function of how much money we make. But what we can say is when you do live paycheck to paycheck, it's very unnerving. It's living in a perpetual state of financial fragility because there's no cushion to fall back on if a short-term emergency situation comes back. And thinking from a longer-term perspective, if you're living paycheck to paycheck, you're not doing anything to prepare a nest egg that can grow for your retirement years. So personally, I like to think about money as a tool. It's a tool that gives us opportunities and choices to make. Every day we're making choices with our money in terms of whether to spend it, borrow it, use it to pay down debts, save it, or invest it. So the choices we make with our money not only impact how and what we're doing today, but the choices we make today are very much going to impact our lifestyle in the future. In this session, we're going to talk about some of the actions we can take to have a secure financial future, both near and long term. The first thing about financial security is that it's about taking control of your personal finances. To me, financial security is both financial and psychological. It's having enough money to fund your lifestyle and already saved in your rainy day fund so you have funds left over to build your assets and long-term wealth. Financial security is also feeling good and confident about your financial situation. It's the ability to manage your money to meet not only your near-term, but also your longer-term needs. When we take control of our money, we can take actions that positively impact our financial stability and financial security. We'll have a vision of where we are going so we don't end up someplace else. A big part of financial security is knowing where your money's going and consistently spending less than your income so that you can save and invest for the future and pay down your debt. A good way to know where your money's going is to create what's called a spending plan. A 30-day spending plan would be a great idea just to get started. And you can do this either using like an Excel spreadsheet or a mobile app, whatever is going to work for you. And at first, developing and maintaining the spending plan may seem hard, but it's like training for a long distance marathon. With practice, you get better and better, and it gets easier and easier. Use your spending plan to track your income and daily expenses. And then one thing that's super important is we need to hold ourselves accountable. So have a daily check-in with yourself every day. It will only take a few minutes, and that will set aside some time for you to not only input what you've been spending your money on, but to get a progress plan on how well you're sticking to your plan and whether you need to adjust it. There's so many benefits to doing the spending plan. You gain a much firmer understanding of where your money's going. The single biggest benefit, though, is that it raises the awareness of what money you have and specifically, what specific items you're spending your money on. And furthermore, the spending plan helps you really stay current on what your upcoming obligations are and what you would like to have, but you might need to exercise some discretion on. And no matter what, include some amount of savings in your plan. I give my students the assignment of doing a 30-day spending plan, and my students always tell me that they benefit so much from doing this. They discover things that they previously hadn't thought about, like how much money they're spending on DoorDash or Grubhub. They discover subscriptions they thought they'd cancel or subscriptions that they're no longer using. So many times I'm asked, well, how should I think about my expenses? And what's on this slide is just a rough guideline, and that is to spend 50% of your expenses on your needs, things like rent and groceries and your utilities and car insurance. 30% on your wants, that would be things like dining out, Netflix, and 20% on your financial goals like saving and paying down your loans. But again, this is just a rough guideline, and everybody should tailor these guidelines to their personal situation. My students tell me that when they start using the spending plan, they actually spend less and find that they have the flexibility to save more. They really feel empowered and on a path to achieving financial security. And most important, it puts them in charge of their money so they can use it as a tool for what's important to them. One thing we want to do is to imagine our future selves so we can own our destiny. When we imagine our future self, we try to think ahead about things like where we want to live in 20, 30, or 40 years, who we'll be living with, and what lifestyle do we want to have when we're in our golden years. I know some of this may seem way too far off in the future, but it really is something we need to think about and plan for. Today, nobody can say if Social Security will be around, no less viable enough to fund payments for us in 30 or 40 years. And if you work in the private sector, you know that companies no longer offer pensions that were there in the past to fund living expenses in retirement. So to have financial security for our future self, we need to build a nest egg that can grow and become a source of long-term wealth. And we do this by consistently saving and investing. It takes patience and a lot of discipline over many years. And I know this can be really hard, especially because the times that we live in, we face so many influences, whether the influences are from social media, our friends, our family, or just life happening. But it really is important to start saving and investing now, even if it's just saving $10 a week. Because by doing this, our money will be working for us so we can get the benefits of compounding returns over time. And that will make a huge difference. And when we save for the future, we're being kind and thoughtful to our future self. So our future self can have not only financial stability, but financial security. One of the biggest keys to near-term financial stability is having a rainy day fund. You may have also heard this referred to as an emergency savings account. Have a specific account designated for emergency situations and keep this account segregated so that it's only going to be used if an emergency situation comes up. If you're in a salaried job, the goal should be to have 3 to 6 months of living expenses in your rainy day fund. If you do freelance work or your income's more unpredictable, you probably want to have more than 3 to 6 months in that account. And this money that's in this rainy day fund should not be invested in the financial markets because you need to know it's there when something critical comes up. So how do you set this up? One thing you can do is set up automatic withdrawals from your checking account on your mobile app so that you can have consistent and periodic deposits into your rainy day fund and have those automatic withdrawals coincide with your paycheck or when other deposits are made to your account so that every time you get paid or receive a deposit, you'll automatically be funding the account so you don't spend it. And you know what? You will find that you don't even miss this money. And most importantly, you'll feel much more emotionally, secure because you know that you have this financial cushion, especially if life goes sideways. So, what are the emergencies that can come up? Well, you could lose your job. Um, you might get a great job offer and have to move to another city, and there could be moving expenses with that. Um, the one that I always seem to bump into is some unexpected car repair comes up and it's not $100. So the thing with these rainy day funds is that they really help you weather these bumps in the road and they help you avoid getting derailed by an event that could lead to more borrowing and ultimately ratchet up your stress. And we don't want to do that. Now, given that we're in the season of filing tax returns, I just had to mention this. If if you are fortunate enough to get a tax refund, one thing you can do is use your tax refund, some part of it or all of it, to either fund your emergency savings account, or you could use it to pay down your credit card debt. So we've kind of talked about short term and near term financial security. What about the long term? As I have thought about this so much over the years and worked with clients and teaching, at Wayne, long term financial security involves being disciplined for many, many years, not just in terms of savings, but also in terms of how you manage your debt. And I wanted to share this with you as well, that according to a recent study by the US Association of Actuaries, the most important driver of wealth accumulation is a function of a person's savings rate. The more a person puts aside every month, the more their wealth would grow. And the reason why this is the case is because of compounding returns, which we're just going to discuss in a minute. But before you even invest in the financial markets, it's important to step back and assess your current financial situation. If you have student loans and other debt, make a list of your debts and monthly payments so you can determine the impact that investing will have on your situation, specifically your ability to comfortably meet your loan and other payment obligations. And if you have high cost credit card debt, have a plan for paying that debt off completely. Credit card companies charge double-digit interest rates on balances we carry from month to month, and the high interest rates paid on those balances erode our wealth and they erode our financial, flexibility. If you pay off the loan balance, what you'll find is that you immediately have more money because instead of paying interest to the credit card company, you keep that money and you can decide whether you want to accelerate the repayment of other debt obligations you have or earn a return on it by saving or investing it. And by the way, paying off credit card debt completely is going to improve your credit score. And that has an ability on the ability to build wealth because when you have a high credit score, you get lower mortgage rates and you get lower insurance premium rates with a higher credit score. So it really does make a difference. Building wealth for the retirement years, it takes a very long time. And if we can start now, we optimize our odds of having financial security in our golden years. Most employers will offer retirement savings plans like a 401k if you're in the for-profit sector, or a 403b if you work for a nonprofit company. And if you are working part-time or your workplace doesn't have a retirement savings plan, you can save for retirement with by putting money into a traditional or Roth IRA, and do this at a highly reputable firm like Fidelity or TIAA. And one question that I frequently get too is like, how much money should I put in? And one of the rules of thumb is to save 10% of your pre-tax earnings for retirement in your first job. But that's only a benchmark. You might be able to save more, you might not be able to save that much. The important thing is to make these savings a reality. And you make them a reality. The easiest way to make them a reality is really just to automate the contributions to your retirement account, either through payroll deductions with your employer or just through automatic withdrawals that you set up, like when you get paid. And you can do this on your mobile apps. And the benefit of doing this is it helps you stay on track so your account will grow from ongoing deposits and compounding returns. And one thing that I found really worked well for myself is that if you can strive to increase the amount you set aside each year, that will really benefit how your wealth grows and compounds. Research shows that ramping up the amount you can save over time is absolutely the most effective way to a more secure retirement. Like one thing you could do, and one thing that I can personally vouch for is if you get an annual raise, consider making a promise to your future self by adding 50% of your annual raise to what you're already contributing to your retirement account. And another super important thing I want you to take away from our meeting today is that many employers will contribute money to your 401k through what's called a match. And what that is if you contribute a certain amount to your account, and that certain amount is specified by your employer, your employer then is going to add some money to your account. And that is totally free money to you. And you want to do everything you can to reach that threshold set by your employer so you can get that free money, because it will increase your return on your account automatically and will help the compounding even more over time. So just to sum things up, building long-term wealth for retirement, the key is to start as early as you can and to keep making regular contributions to your investment accounts so your investments will grow long term. I wanted to show how you can make time and the power of compounding like your best friends in terms of investments. And what this chart shows, if you start at the top, if you start contributing $500 a month when you're 25, and let's say your average annual return, that is the return you get every year, is 6%. And that's actually a pretty conservative return. You should be able to do better than that. So over 40 years, contributing that $500 every month, you will have contributed $240,000 to your retirement account. But the beautiful thing is that time and compounding will work to grow that 240,000 to 933,000, or almost $1 million by the time you're 65. That is the magic of compounding. Now, let's say you wait until you're 45 to start saving for retirement. If you look down that far right-hand column and you contribute the same $500 every month for 20 years, and let's keep the assumption consistent that you earn a conservative return of 6%. Well, over 20 years, that is from the time you're 45 to the time that you're 65, you will have contributed $121,000. And with compounding, that money will have grown to $220,000. But I just wanted to share this with you so that you can see how important it is to invest as early as you can and consistently invest over time so that you can be a millionaire. I think we have a question here in the chat. Can you talk some more about envisioning your future self and how this provides motivation to reach your financial goals? Sure. So, when you think about your future, you may be able to think very specifically, like, I want to retire in California. The first thing is to kind of get a picture in your mind. And you want to live somewhere near the mountains, let's say. So then I'm a very logical kind of person. And so, then I would go and look up like how much it costs to live in LA. And that would probably honestly send me reeling because it's super expensive to live in LA, and especially to be able to see the mountains. But it also helps you become more realistic and helps you understand that if you have that kind of goal, it helps you get a handle on what kind of money you're going to have to accumulate to have that lifestyle. Um, Another thing you can do is envision, things like, do you want to travel a lot? Do you want to live in an apartment instead of having all the expenses living with a home? And honestly, this is something that probably is changing for all of us over the years. But it's important to keep that future self in mind because it will help you stick to your plan so that you have options. Because when you do get to the retirement years, the thing about retirement is that it's not like your education where theoretically you can take out a loan to pay for your education. In retirement, like you really can't take out a loan. You have to live with whatever social security is going to pay you and then live off whatever liquid assets you have in your retirement account, or if you own real estate and you're getting rental payments from your real estate investments, that is what is going to pay your living expenses. Thank you. Um, and I can share with you that um, the vision that I had for myself when I was in my mid 20s is very different than I have now that I have a daughter who is graduated from college. Um, some other questions that I often get asked, and things that you might want to think about: how do I invest my assets? And this is fundamentally a question of how much risk you want to take versus the potential return you're going to get. And there's something called the universal rule of investing. And that rule is that the more risk you're willing to take, the higher the potential return. So, to build your long term wealth, quite honestly, if you put all your savings, let's say in a traditional savings account or in a money market account that's offered by the retirement plan, the interest rate that you're going to get on that is going to be extremely low. And the problem is with doing that is the way that this math works, as you can see from this slide, is that the compounding is just not going to um, grow those assets into a large enough amount. And what that means is by the time you get to your retirement years, you will have lost so much purchasing power. Um, I mean, think about the inflation we're seeing today, the 6, 7, percent inflation rate. Um, if your money is only growing at 1 or 2% a year, your lifestyle will take a huge downshift in retirement if your investments haven't at least kept up with the pace of inflation. Um, and like I said before, this is not meant to give anyone investment advice. That said, one thing I can tell you is that the stock markets on average, going back to the mid 1920s, have returned on average 8 to 10% per year. So, um, there's definitely risk, and you never know where the markets are going to be when you need your money. But over time, over 10, 20, 30 years of time, you can ride the ups and downs of the market, which I'm going to get to in a second. Um, Another question that I get all the time, I have a consulting business where I help people with a range of financial issues, and I just had this with a client: how much do I need to save for retirement. And the question really needs to kind of be turned around, because the key to figuring out that number is trying to get a handle on what your expenses are going to be. And one thing we know for sure, no matter how far out in the future you're looking, whether it's 10 years or 20 years or maybe even 40 years, is that living expenses are going to be a lot higher in the future than they are today. And whether that be housing expenses or just, your daily living expenses. And healthcare expenses, they keep going up, and healthcare expenses increase in old age. And I wanted to mention that there's some really good online calculators available for free that you can play around with and start to get a sense of how your money will grow. You can put in like different return assumptions, different monthly contribution assumptions. If you go to bankrate.com, they've got a really good retirement calculator. Nerdwallet.com also has a good retirement calculator. And I'd also suggest, if you want to do a deeper dive in terms of investor education on investments, the Securities and Exchange Commission has an outstanding investor education tab on their website. So that's sec.gov. Whether your retirement account is, company sponsored retirement plan or an IRA, be sure to review your retirement savings accounts periodically, whether it's quarterly or at the end of the year. And the important thing to look at on the statements is, what is the market value of your retirement savings? I really think it's a great idea to look at the market value of your retirement account at the year end. Like, you could even look up where you were at the end of 2021 and compare it to December 31st of 2020. Hopefully you were in the stock market, because the stock market had a great year last year. Another thing I want to share with you is, don't be overly focused on short-term performance. Investments, especially when you get involved with things like real estate and the stock market, they're for the long term, like for periods of 8 to 10 years and longer. And when the markets fluctuate, by all means, don't panic. Because what happens is that panicking causes people to sell when prices are low and to buy when prices are high. And that's exactly the wrong thing to do. You cannot make any money doing this, and you are going to whipsaw your investment account. And if you have the flexibility, when markets go down, try to add some money to your investment account, because that's how you make the big money. You're buying when prices are low, and then you get the benefit of prices going back up when the market rebounds. So this is an example of what I was alluding to just a moment ago. You need to stay in the market through the ups and downs to truly get those benefits of compounding returns. This is from a JP Morgan asset management study that looked at, if you put $10,000 into the stock market on January 1st, how that money would have grown over a 20-year time period. And this is just using the annual returns of the S&P 500. So if you put $10,000 in the market on January 1st of 2001 and kept it in all those 20 years, that $10,000 would have grown to $42,000. Now we've definitely had some scary moments in the market since 2001. We had the financial crash in '08, '09. We had the market downdraft in the fourth quarter of 2018. We had the huge pullback when the pandemic hit in March of 2020. But if you just hang in there and ride out these bumpy periods, your money will really grow nicely over time. If you panicked during one of those time periods, let's say, and you missed 10 of the market's best days, your money would have only grown to about $20,000. And if you missed 30 of the best days, you would have actually lost money. So the overall point is, just hang in there, let your money compound over time. It's really the best way to build your wealth. Does anybody have any questions on this? So I wanted to close with this. It's a quote from Earl Graves, who was was president of Howard University. Hold on to your dreams of a better life and stay committed to striving to realize it. And I think that's such wonderful advice in terms of taking control of your personal finances today and being as good as possible to your future self. And I'm happy to answer any questions you have.
Julie, we have a question in the chat from Louie.
Okay. So that's a great question, Louie. I don't know if you need that money for your living expenses. I'd really need to understand to give you the best possible answer. Understand whether you need any of that money for your living expenses. If you don't need that money for living expenses, I'd recommend saving, as much of it as you can. I mean, at least start with, if you can save 10% of that every month, that would be great. Oh, I love that question, Cassandra. How do we find a trustworthy financial advisor? Okay, so I'm going to put something in the chat here. The first thing you should do is look up the firm and the investment advisor on this brokercheck.org website. And if you need any help, here, I'm going to put my email in the chat here too. If you need any help with that, let me know. So what you always want to do is, first of all, find out if the advisor has had any regulatory missteps. Because trust me, there are so many financial advisors out there who are great talkers, but let's put it this way, you need to be cautious. So the first thing that I would do is look them up on brokercheck.org. There's other things that you can do as well. You'd want to meet with that person and get a feel for, I'd ask them how they would invest your money and see how they talk with you about that. They should be asking you about when you need the money, what your risk tolerance is, questions like that. And, do you have a specific, oh, thank you very much, Andra. Thank you very much. He was on the board of trustees. Thank you. You want to kind of really listen closely. How is that person talking with you? And you want to understand if he's going to be selling you. You definitely want to ask the question, are the products you sell me, are you getting a commission on them? And how do you make a decision on whether you're going to sell a product that's pushed by the firm or one that might have better investment performance? That's a key question to ask. Let's see. There's some other questions. If you want to send me an email, I'd be happy to send you a whole list of questions, because it's really important that you do that. And it's super important to research the firm too, because I was recently working with a client who had been recommended to go to a certain financial advisor. And when I looked up that firm that the financial advisor was with, there were probably 44 regulatory infractions, things like appropriating client money, fraudulent wire frauds, that kind of thing. And that's the thing that you can find out by going on broker check if there've been any these kinds of problems in the past with the firm.
Julie, we have a question in the chat from Kelsey. Do you lose part of the returns that you get when you go to pocket the money earned from a Roth IRA or investing? If so, how much? Trying to figure out if it is worth it to do so.
Okay. It's my understanding that everything that you put in an IRA, so you're putting in after-tax dollars. So my understanding of the Roth IRA is that when you go to take it out, you are not taxed on that money. The question of a regular or Roth IRA comes down to, quite honestly, do you think your tax rate is going to be higher in the future than it is today? And right now, personal tax rates are at 100-year lows. So, but this is a question everybody needs to answer for themselves. If you think that you're going to have less income when you retire than what you have today, then it might make more sense to go into a 401k. I mean, a pre-tax, 401k. If you think you'll be in a higher tax bracket, then for sure you want to go with a Roth IRA. It's really such an individual question. It comes down to what your income is today and what you think your income's going to be in the future. Myself, I believe that given that tax rates are at these 100-year lows, I personally believe that tax rates are going to be going up. But again, it's a very personal decision, specific to your career path and lifestyle issues.
Julie, there's another question in from Nikechi.
Okay.
Would you advise one rather invest money towards retirement, since that is many years off and the returns will be compounded over time, than saving it in the traditional way to evade the effect of inflation?
Boy, that is a really great question. So in the ideal world, you'd want to have the flexibility to save for retirement and invest for retirement and have a taxable investment account that could also grow over time. In the ideal world, you'd be able to max out your savings that you could put into your 401k and still have some money left over to, like I say, put in a taxable investment accounts. Um, because as long as you're investing in assets um, where you have to take more risk to get a greater return. But if you can stick with those investments over time, they should compound over time and appreciate in value. In other words, increase in value, so that your purchasing power will be maintained, if not enhanced. I hope that answers the question, Nkechi. Um,
Any other questions? You can put your hand up or just speak up or put it in the chat. Julie, I have a question. I put it in the chat a little earlier, but I wanted to get to our participants' questions first, and it concerns the stock market. I know you are emphasizing stick with it in the long term, but given all that's happening in the world these days, what's your prediction on the stock market for the next year?
You know, that is the question of the moment. And I don't think anybody can predict the direction of the stock market. There's so many variables right now. We've got rising interest rates. We've got the war in Ukraine. We have high oil prices. We have much higher levels of inflation than we've seen since the financial crisis. And the question that everybody's grappling with is, how do these forces combine to impact economic growth and corporate profits in the coming months? And I don't think anybody has the answer to that, quite honestly. The one thing we can say with certainty is that we've enjoyed the longest bull run in the stock market in history. And there is a reversion to the mean at some point. So, I know that probably doesn't give the answer that you want, but I just think anybody who tells you that they can predict the direction of the market it's like throwing cards up in the air. I mean, it's just too unpredictable to really know.
Thank you. We have 3 more questions that have come in on the chat. Kelsey writes, a Roth sounds the way to go if you're in a low tax bracket now and see yourself in a higher bracket before retirement / at retirement stage in life.
Yes. I mean, that's what I've advised my daughter to do, because she's just starting out. And I just think these tax rates are inevitably going to be going up. They just cannot be sustained at this low level. And I don't want to get into a political, conversation, but you just look at the long-term charts and what's happened historically in this country, and it just seems like it's a matter of time before they go up in one way or another.
Jerry has a question. What is your advice on investing in cryptocurrencies?
Okay, so let me start out by saying, Jerry, that I'm very skeptical about cryptocurrencies, and I'm super happy that we have the current chairman of the Securities and Exchange Commission that we do. My own view on cryptocurrencies is that they're very speculative. The value in cryptocurrencies, to my investment way of thinking, is in the blockchain. And there's just not enough investor protection when you go and invest in cryptocurrencies. What do I mean by that? Well, number one, you have no way of knowing, since the platforms that you would buy cryptocurrencies through, they're not regulated like, let's say, a Fidelity or a TD Ameritrade, or, like a bank with a brokerage operation is regulated. So what we've seen, even in the last year, I read this morning that there were, let me get this number right, $100 billion in cryptocurrency trades, and 14 billion was lost due to security breaches and scams. So that's a very high percentage of assets to be lost through scams, and not enough security and to protect the investor on the platform itself. I firmly believe that the United States is headed towards a digital currency. It's not a question of if, it's a question of when. I mean, we're all going to be, having our wallets on our phone, the digital wallets. I just think that, and I've been wrong all the way up, because I know these cryptocurrencies have had huge runs, but to me, there's no there. It's not like there's no solid asset behind these things. We're in the early stages. And I think once there's more regulation to protect the investors, then I think they'll be relatively safer to invest in. Because, like, what happens if your account gets hacked at, let's say, a Fidelity? There's a whole legion of people that's going to help you, recover your assets. Coinbase was hacked last year. The people whose accounts got hacked, they didn't get their money back. It's gone forever. So that is personally a huge concern I have on cryptocurrencies. Then there's a whole issue of, if you lose your key, it's not like you can get that back. You lose your key, you lose everything. So that's my personal advice. They're in the very early stages. They need a lot more regulation. I hope that was helpful.
We have a question from Rio on bond investments. Are they a good investment in today's economic environment, or should we stick with stocks for the time being?
Okay, so that's kind of a tricky question in this kind of environment, because the role of bonds in a portfolio is kind of to be the post in the storm. They're not supposed to be as volatile as stocks. But what we saw in the first quarter is that bonds actually had worse returns than, let's say, the S&P 500. So I think if to invest in bonds, if you can, and if you want these in your portfolio, and I have them in mine, there are some good bond ETFs that you can buy. And I would encourage you to look into those, and see what your comfort level is. And one way that you can invest in bonds in a market where interest rates, we know they're going up. And the question is just how much are they going up and how fast? Because that is truly having the wind in your face in terms of bond investments. But one thing you can do is you can sort of what's called dollar cost average into a bond ETF. So let's say you're going to put $10,000 in a bond ETF. You could put $1,000 in, every month for the next 12 months. And that way you'll be buying shares, as interest rates go up and the prices fluctuate, you'll be able to buy your way into that ETF when prices are lower. And be sure, unless you need the income from the bond ETF, you want to have the income from the bond ETF reinvested so you can get the benefit of growing that asset. They're
Well,
very very tricky in this environment, but it doesn't mean necessarily they should be zero. It really depends on, again, your risk appetite, and what you're comfortable with.
it looks like we have time for one more question. This is from Louis. I'm a grad student in English. What do you recommend I try to save with the income and future savings I make to provide a comfortable future for myself?
Um, but, again, that really comes down to your income and what you need to cover your living expenses, um, and where you ultimately work. You should try to save something. And I'd encourage you to go to that bankrate.com retirement calculator, just so you could get a sense of, even if you just kind of play around with what your current expenses are, and so you can see how much you would need to have for the future, just to get a ballpark idea. It's really hard to give a specific answer to that without knowing, what your current expenses are. And if you want to send me an email, we could set up a Teams call and I could talk with you further.
Julie, we have a
Oh,
question about.
Ethan, yes, hello. Okay, so foreign exchange trading is that's kind of it's one of the most difficult areas to make money in. That's like trying to predict the direction of foreign exchange rates is like trying to predict the direction of the stock market. Personally, if you're interested in getting exposure to other currencies, something you might think about is investing in an international stock fund, whether it be the global stock index fund or an actively managed mutual fund. That's really a better way to diversify your exposure to currencies outside of the US dollar. Socially responsible investing, firms and website. That's a great question too. You can look at it depends on like how narrow or broad your definition of socially responsible investing is. BlackRock puts itself out there as being very, mindful of socially responsible investing. The thing with socially responsible investing is that you have to peel back the covers of the investment and really see what the underlying investments are. So I would start with a place like BlackRock. And you could also look at some of the big online brokerage firms like Fidelity or Vanguard, and just see what they offer. But be sure to look at the underlying holdings, because many times these firms will say that they are offering you the socially responsible investment product, like that's very environmentally friendly, socially responsible, has good governance. But then when you really look at their holdings, all they've done is omit anything with guns or tobacco. They haven't gone any deeper to find out, if these companies are doing things that are harmful to the environment, et cetera, et cetera, et cetera. So happy to talk further with you. If you want to send me an email, we could set up a Teams call.
Well, I think we're about ready to wrap up. It's 4:06. I want to thank everybody and thank Julie for joining us. This is our last professional development seminar for this academic year, but we will be back next fall with a fresh new lineup for you. So stay tuned. We're busy planning the graduate school for those new seminars. In the meantime, watch your email. You'll be receiving a follow-up email from today's seminar with a link to the seminar and a brief survey. Please take a few moments, it's not an extensive survey, to tell us what you think. Your feedback is extremely important to us. So thank you, everybody. Have a great rest of your day, and we'll see you in the fall.
Thank you very much, everybody. Great to meet all of you.